The entire market just completely panicked over enterprise software. We saw this massive macro-driven sell-off fueled by sheer terror over IT budget cuts. And it violently dragged ServiceNow stock down to $95.56. But here's the massive, glaring disconnect that almost everyone missed. While the market was obsessing over a potential software spending slowdown, ServiceNow quietly crossed an explosive fundamental milestone, a $1 billion AI breakout. And that's exactly the tension we're breaking down today. You really have to ask yourself, why is a company that is actively, undeniably proving its generative AI strategy works being priced by the market as if its growth is completely stalling out?
So investors saw these dire warnings from peers like IBM and Pegasystems, right? They immediately worried that enterprise IT budgets were being diverted entirely away from software, just dumped straight into hardware and data centers. The assumption was that software licenses were getting slashed across the board. But the reality is completely different. When ServiceNow reported its Q2 '26 numbers on July 22nd, they didn't just survive this supposed panic, they absolutely shattered it. They proved that, for them at least, AI is not some disruptive threat causing margin compression. It is a massive, highly monetizable, secular tailwind that's actually accelerating their core business.
Section 1. The $1 billion disconnect.
$1 billion. This is the annual contract value milestone that ServiceNow's AI portfolio, driven by their Now Assist suite, just crossed in Q2. And the crucial thing here isn't just the number, it's exactly how they're achieving it. You see, they aren't just selling more basic legacy software seats. No, they've introduced value-based and transaction-based pricing structures. Enterprise customers are out there willingly paying premium prices for autonomous agents that execute multi-step tasks right inside their existing workflows. We're talking about things like automatically resolving IT tickets, entirely onboarding new employees, or routing complex customer service queries without any human intervention at all. This single billion-dollar number proves that ServiceNow possesses unprecedented pricing power in the AI era. They are literally shifting from a pure software-as-a-service model to a highly lucrative outcomes-as-a-service model.
Section 2. ServiceNow's unbreakable moat.
Okay, so to really understand why enterprises are throwing $1 billion at ServiceNow's AI, we have to look under the hood at the underlying economic engine. Look at the sheer predictability of this business model. A staggering 97% of ServiceNow's revenue comes from subscriptions, pulling in gross margins around 78% on a non-GAAP basis. The remaining 3%? That's just professional services and training, which they actually intentionally run near a gross loss just to reduce onboarding friction for new clients. But here is the absolute kicker. The renewal rates consistently hover between 97 and 98%. Why is it so sticky? Because they act as the central nervous system for a company's entire infrastructure. At the core of ServiceNow is the Configuration Management Database, the CMDB. This database meticulously maps every single server, router, software license, and employee device in a Fortune 500 company. Once a massive enterprise embeds its custom configurations into the system, migrating away is practically impossible. Seriously, it represents tens of thousands of internal engineering hours and millions of dollars in consulting fees just to rip the thing out. That immense data gravity is exactly what makes their revenue virtually bulletproof, even when the macroeconomic environment takes a downturn.
And that data gravity perfectly sets up their competitive positioning within a rapidly expanding total addressable market. Think about the landscape. You've got Microsoft operating at the desktop collaboration layer with Copilot, helping you write emails or summarize Teams meetings. Then you have Salesforce dominating the front office, acting as the system of record for customer relationships and sales pipelines. But ServiceNow? They operate as this ecosystem-agnostic orchestrator in the deep, complex back office. Because they hold that dense operational data, they're actually gaining ground against the tech giants. They've built what they call an action fabric that actually allows third-party AI models to execute tasks directly within their system. So they aren't really fighting Microsoft and Salesforce head-on in a brutal feature war. They're orchestrating them. They're serving as the definitive, foundational layer where actual enterprise work gets done. And hey, by the way, if this kind of deep research-first analysis is your thing, you'll probably want to subscribe.
Section 3. The Q2 Earnings Reality Check. We've talked about the structural moat, we've talked about the AI momentum, but let's get back to July 22nd, 2026. Because that is when the market's bearish narrative crashed headfirst into ServiceNow's actual financial results. The numbers here are just undeniable. They aggressively beat Wall Street consensus across the board. Total revenues hit nearly $4 billion, up 24.5% year over year, but the metric I really want you to focus your attention on is CRPO, Current Remaining Performance Obligations. For any software-as-a-service company, CRPO is the absolute lifeblood metric.
It tracks short-term bookings and future revenue already under contract for the next 12 months. It came in at a massive $13.2 billion. That's a 21% year-over-year growth rate. Keep in mind, management had only guided for 19.5% in constant currency. That huge beat entirely disproved those lingering fears of an enterprise IT spending freeze. Oh, and they also beat on the bottom line, delivering 90 cents in non-GAAP diluted earnings per share against an 86-cent consensus. Now, to give those numbers some real context, let's listen to what CEO Bill McDermott highlighted on that earnings call. He outright stated that agentic deployments of ServiceNow AI have increased ninefold over just the past 9 months. Ninefold. That kind of explosive adoption is driving so much long-term customer commitment that McDermott noted it positions the company to move from the rule of 56 to the highly elite rule of 60. And if you're not familiar, in the software world, combining your growth rate and your free cash flow margin to hit 40 is considered exceptional. Hitting 60? That's almost unheard of at this kind of massive scale, and it signals absolutely unparalleled operational leverage.
Section 4. The Qualitative Business Scorecard.
The financial trajectory here is incredibly strong. But let's step back from the quarterly spreadsheets for a moment. We need to synthesize a qualitative analysis of the company's overall health, their management alignment, and where the real vulnerabilities actually lie. Looking at the business scorecard, you see a fortress of a company with an overall 8.0 out of 10. Revenue quality and financial health are undeniably top tier at 9 out of 10. I mean, they hold a massive net cash surplus of $3.88 billion and boast that 97% subscription stability we talked about. But notice those lower scores in profitability and capital allocation. While non-GAAP operating margins are a stellar 29.5%, the GAAP margin is only 4%. That massive gap, it's driven by incredibly heavy stock-based compensation. It's a harsh reality of retaining top-tier AI engineering talent right now, but it's a drag on real shareholder returns nonetheless. Furthermore, capital allocation takes a hit down to a 6 out of 10 because of their recent $7.75 billion acquisition of Armis. They bought it at a very rich multiple of 23 times ARR, which creates near-term margin pressure and carries some pretty heavy integration risks.
Real quick, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now, and every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also gives you Portfolio Watch, which monitors your portfolio and flags important changes, plus Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Just scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 5. 5-year scenario analysis. Let's apply all of this foundational data to a rigorous mathematical framework. But before we look at the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
All right, let's break down the operational math, starting from our July 22nd entry price of $102.06. We're modeling this out to 2030. In our base case, which carries a 50% probability, we assume steady enterprise adoption of the Now Assist AI suite and a relatively smooth integration of their recent acquisitions. Under these conditions, revenue compounds at an 18.5% rate, hitting management's target of $31 billion by 2030. Free cash flow margins expand nicely to 38% as AI efficiencies kick in internally. Applying a 28x price to free cash flow multiple, which is historically very reasonable for a high-moat software compounder like this, gets us a projected share price of $323.89. Now, in the high case, we assume rapid generative AI monetization and premium autonomous agent pricing drive explosive leverage. Revenue compounds at 21.5%, free cash flow margins hit 40%, and aggressive share buybacks actually succeed in shrinking the total share count. Because growth accelerates, the market naturally rewards them with a higher 32x multiple, giving us an implied price of $455.07. But we absolutely must look at the low case. If Microsoft and Salesforce successfully pressure pricing through aggressive bundling, revenue growth slows down to 14%. Margin compression drops free cash flow to 32%, and that heavy insider stock dilution completely outpaces the buybacks. In this pessimistic scenario, multiple compression drags the valuation all the way down to 18x, giving us a target of $133.42.
And just a reminder, if you want to access the full model with all the detailed assumptions behind every single one of these cases, you can check out the detailed research report over at flash.stocksentinel.ai.
When you step back and blend the probabilities of those three scenarios together, the main takeaway is pretty clear. We're looking at a probability-weighted target price of $309.07 over the next 5 years. Essentially, if ServiceNow simply maintains its 18.5% baseline growth trajectory, continues monetizing its AI products effectively, and integrates its acquisitions properly, that current $102 entry point, caused entirely by that temporary macro panic, offers some massive asymmetric upside.
Section 6. Major Risks and Final Verdict.
No thesis is complete without looking at the threats that could actually break it apart. We need a concrete, decision-useful breakdown of the real risks standing in the way of that $309 target. So let's be totally honest about the headwinds here. First up, stock-based compensation. As we noted, the gap between a 4% GAAP operating margin and a 29.5% non-GAAP margin is just massive. While they've spent over $10 billion on buybacks over the last 5 years, honestly, it has mostly just absorbed that dilution rather than meaningfully reducing the total share count. Second, they've spent over $11 billion recently on M&A, including Armis and Vesa. Integrating that completely distinct technology architecture without destroying their return on invested capital, that is a huge operational hurdle. Third, the competition. If enterprises start pushing back on paying premium, transaction-based prices for AI, deep-pocketed competitors like Microsoft could easily bundle AI agents into their existing enterprise agreements for free, heavily pressuring ServiceNow's market share. And finally, macro shifts. If companies are actually forced to divert all their IT budget to physical chips and data centers, those massive software license expansions we've been seeing could stall temporarily.
So, to resolve the big question we started with, ServiceNow is not stalling, not even close. It is a highly resilient compounder that survived a major macro panic by proving its AI execution is real and incredibly lucrative. The market fundamentally mispriced the stock by completely ignoring the $1 billion AI reality happening right under the surface. Going forward, the two most important catalysts you need to watch are whether constant currency CRPO stays above that crucial 20% threshold and whether their subscription gross margins stabilize as they digest these multi-billion-dollar acquisitions. The ultimate question to leave you with is this: if a $1 billion AI run rate is what ServiceNow looks like during an enterprise software slowdown, what in the world happens to their valuation when the broader macro environment actually speeds up? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.